How much money is it going to take for you to get into your dream home? Hi, my name is Samuel Johnny. I'm the branch manager of the Southwest Funding Office located in Southfield, Michigan. I'm right off 12 Mile and Telegraph in the Onyx building. I've helped hundreds of families finance properties and get into their dream homes, their first homes, refinance their current mortgages. And I do these videos as a way to help educate you prior to you going into the mortgage and home buying process. So today we're going to discuss something that's a very common question I receive. How much money is this going to cost me, Sam? You know, I've seen things online, or I know that, you know, for conventional you need 20% down. So I'm going to go over some of those things and get out some of those myths so that you can properly understand exactly how much money this is going to cost you depending upon a specific loan amount you're interested in. So the first thing we need to discuss is the difference between a down payment and closing costs. So your down payment is going to depend on the actual program that you qualify for. So if you qualify for an FHA loan, you have a different down payment than you do on a VA loan. All right. If you qualify for a conventional loan, there's a different down payment than that's required on a USDA or rural development loan. So the first thing we need to do is look at the actual programs. All right. So we have conventional. I hope this is big enough. We have FHA. We have VA. We have RD or USDA. I'm still not sure which one that's what they call it, but yeah, so each one of these have a different minimum down payment requirement based on the program. All right, so for conventional, you're going to be anywhere between 3 to 20% down, okay? You can go 3% down on a conventional loan. A lot of people think you need 20% down, but you can go 3% down using a Home Ready program or Home Possible. If you're a first-time home buyer, 3% down is a definite possibility for you. All right, FHA, 3.5% down. All right, VA, you don't need any money down on VA. Same thing with USDA, you don't need any money down. So if you're an active duty military personnel and you're renting a home, it makes no sense for you to be doing so because you have a 0% required investment for a VA home loan. So that means that you can literally, I've done these before. I've literally done VA loans where a guy shows up to the table with $500 just to cover his closing costs. So these are your down payments. All right, down payments. All right, so for conventional, you can go anywhere between 3 to 20%, and you can put down more than 20%, but this is just what's required to eliminate the PMI, 20%. But you can go 3% down as a minimum, 3.5% down for FHA, which most people are familiar with. VA, no money down. USDA, same thing, no money down. USDA loans are for those that are looking to live in the outskirts a little bit from the metropolitan areas. So you'll look at South Lyon, I think Brighton, some areas like that, but more north of like our Tri-County area. But you know, if you don't mind driving 40 minutes to work, then yeah, you can get into a home with no money out of pocket. And I know a lot of people that do. I've only financed one of these loans, but I know a lot of people that live out there and they commute, you know, to downtown Detroit every day. So we have our down payments, okay? So now we need to talk about closing costs, all right? So closing costs are separate. Your closing costs are going to be based mainly on the property. So when you're getting a home, you have to pay property taxes and you have to pay homeowners insurance. So your closing costs, the majority of your closing costs are going to be those property taxes and homeowners insurance. And then you're going to have like lender fees for origination, interest per day, escrow, stuff like that. But the bulk of those things are going to be based on that property. So for closing costs, you have origination fees. All right, and these basically are lender fees. All right, then you have your taxes and insurance. All right, so when I say taxes and insurance, I'm talking about things that have to be paid in advance, so like prepaid items, so things that you have to pay at the closing table. So in Michigan, we have to reimburse the seller for any taxes that they've already paid for the upcoming year. So then you have your escrow account. So your escrow account, look at your escrow account like a savings account, but it's at the bank. So you basically make one monthly mortgage payment, and a portion of that monthly mortgage payment is set aside to pay your future obligations for taxes and insurance. So when you first move into your home, you're going to pay 12 months of insurance up front, and then you're going to pay a prorated amount of the taxes depending upon what period of the year you're closing in. You're going to have to reimburse the seller for the taxes that have already been paid. Then your escrow account is set aside for you to pay your future taxes and insurance obligations. And then you have interest, all right, which isn't much. And then you have your title fees. So the title company or title attorney, they have to be paid to basically handle the transaction, making sure all the docs are properly recorded and things like that, and basically making sure the funds go from one party to the next to pay for the home. So you have your down payment based on the actual loan program, conventional, FHA, VA, USDA, or RD, and then you have your closing costs for origination, taxes and insurance, escrow account, interest per day, and title fees. All right, I think that's pretty much it. So what to expect from closing costs? We already know what you can expect from your down payment. You can go as little as 3% on conventional, 3.5% on FHA, nothing down on VA, and nothing down on USDA or RD. Your closing costs, on the other hand, they're going to range between, I would say, 3 to 7%. Okay, is that in there? Okay, that's in the screen. It's in the screen. All right, so 3 to 7% is what you can expect. So if you're purchasing a home, let's just say for $100,000, all right? Let's say you're looking to purchase a home for, so purchase price, and bear with my handwriting, so $100,000, all right? So you're purchasing a $100,000 home, your closing costs are going to be 3 to 7%, okay? So closing costs are going to be what? $3,000 to $7,000. Now, that seems like a very wide gap, okay? The closing costs are going to vary dramatically if the home is currently under non-homestead taxes or something like that. Or if you're buying a home, let's say you're purchasing a home in Oakland County. Oakland County, in most cases, has more expensive taxes than in Wayne County, all right? So if you're purchasing a home in Oakland County, then the taxes may be, $5,000 as opposed to the same loan amount in Wayne County, the taxes may only be $2,500. So that's going to change this, and that's going to move the needle more north than you staying close to the 3%. So if you're looking to save money, which everyone is, one thing that you can do is you can either finance your closing costs. So you can finance closing costs. That basically means you're going to increase your interest rate to give yourself a credit, and that credit is going to offset some of this. So let's say you increase your interest rate from 4% to 4.5%, and now you're going to get a 1% credit to cover your closing costs. So if you were bringing in, let's say, 3% in closing costs, well, now you're bringing in 2% in closing costs. So that's how that works. So essentially, people say, okay, we're going to give you a loan with no money out of pocket. And, you're not going to have to pay anything. Well, you're going to pay it, but you're going to pay it over 30 years or however long your actual term length is, because you're going to increase your interest rate, which means you're financing it, and that's going to offset the amount that you're bringing to closing. So when you increase your interest rate to pay off your closing costs, you're financing your closing costs over a longer term. All right, so that's what that means. Or you can ask the seller to help cover some of the closing costs. So if you're going into a VA loan, and you have no down payment as far as the actual loan program is required, but you have another 5% in closing costs between your origination, taxes, insurance, escrow, interest, and title fees, you can increase your interest rate a little bit to cover 1%. So let's say you cover 1% by increasing your interest rate, and then you can ask the seller to cover the other 4% in seller concessions. All right. So now you got the 1, and you got the 4 so now you got a 5%. So that covers everything, all right? So if you're going into a VA loan, then you could essentially say, okay, I don't have anything as far as my program requirement. I'm buying a home for $200,000. My closing costs total 5% of my loan amount. So I need $10,000 to cover all of my closing costs, all of these things, taxes, insurance, origination. So I'm going to increase my interest rate to give me a 1% credit. And then I'm going to ask the seller for a 4% seller concession. And that's it. Now you can literally get into that home with no money out of pocket. So These are the things that you guys need to remember. Down payment is based on the program. Closing costs are based on the property and the lender. So that's it. So I hope you guys learned something today. If you have any questions, give me a call, 248-519-2117. I'd be happy to help, answer any questions or get you guys headed in the right direction. Once again, this has been Samuel Johnny with Southwest Funding. Have a great day.